An index is a gauge of the performance of a basket of securities. For instance, the MSCI India or Nifty or the BSE Sensex indices are the gauges that tell us the performance of the Indian markets. An index provider has set rules and eligibility criteria for formulating an index. Factors such as market capitalization, free float, investment cap on foreign portfolio investors, liquidity and sectoral composition are key for a stock to qualify. Index providers give importance to sector composition to ensure that the index has a representation of companies belonging to diverse sectors. For a globe index like MSCI India, the broad principles are the same. However, since indices give importance to FPI legroom, as these indices are used by funds outside India. A company that is not part of an index may do so well that it may become bigger than the companies that are part of an index. So, how does that company make it to the index? For that to happen, index providers conduct the rebalancing or review of the indices every quarter. During the review, they assess if a stock or stocks which are not part of their index can dislodge a stock which is part of the index. This is done based on predetermined quantitative parameters like free float, market cap, sector composition, etc. For instance, Tata Consumer Products replaced state-owned GAIL India in the benchmark Nifty 50 index in March 2021. This was because the former's free float market cap had surpassed that of GAIL during the review period. Typically, a stock that gets added to a large index tends to do well, while the one that gets removed tends to underperform. This is because whenever a stock is added or removed from an index, the ETFs tracking the index also have to realign their portfolios. In other words, they have to sell a stock that is removed and buy a stock that gets added. Analysts try to predict which stock will get added and removed based on publicly available data ahead of an official announcement so that they can position themselves to benefit from the ensuing rebalancing of ETFs. FIF is a term used in the context of global indices. As mentioned earlier, indices compiled by MSCI and FTSE are mostly tracked by foreign funds, so the availability of investment room for FPIs is critical. A stock cannot be added to a global index if the FPI investment limit is exhausted or close to getting exhausted. FIF is a key metric which takes into account the actual free float available for FPIs. For instance, HDFC Bank, being such a large corporation, isn't part of the MSCI indices as there is not enough legroom in the company for FPIs.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.